You know what's terrifying? We learned nothing from 2008. Absolutely nothing. The same shadow banking system that nearly destroyed the global economy 17 years ago, it's back. Bigger, more dangerous, and following the exact same playbook. See, financial crises aren't random chaos. They're patterns, cycles that repeat across centuries because human behavior never changes. Rome debased its currency and collapsed. Venice's banks over-leveraged and imploded. The 1929 crash, the 1980s debt crisis, 2008, all following the same script. And right now, we're in Act 2 of a crisis most people don't even know is happening. This is about the Eurodollar system, $14 trillion in offshore dollars that exist outside anyone's control. It froze in 2008 and nearly killed global trade. We fixed it by doing nothing, and now it's freezing again. Let's go back to where this shadow empire began. Everyone thinks dollars are controlled by the Federal Reserve, but there's $14 trillion floating outside America that the Fed doesn't even touch. This shadow empire is cracking, and when it falls, 2008 will look like a practice run. This isn't new. It's happened before, to Rome, to Venice, to the British Empire, and now it's our turn. Long before the Eurodollar, there was the Roman denarius problem. In the 3rd century AD, Rome faced something eerily similar to what we're seeing today. The empire had grown so vast that distant provinces couldn't get enough real Roman silver coins. So local mints started creating their own versions, claims on Roman currency that weren't quite Roman currency. Sound familiar? When Emperor Diocletian tried to fix the crisis in 301 AD, he discovered the empire was flooded with debased coins that looked Roman. The provinces had created a shadow monetary system. When trust collapsed, trade across the empire froze. Soldiers refused payment. Merchants hoarded real silver. The greatest economic system the ancient world had ever seen ground to a halt. Fast forward to the 1340s Venice. The Venetians had built the medieval world's first international banking network. The Peruzzi and Bardi banking families were the J.P. Morgan and Goldman Sachs of their era, lending vast sums to English King Edward III to fund his war with France. These weren't loans in Venetian currency. They were complex credit instruments, backed by expected wool trade revenues and future tax collections. And then Edward defaulted. The Peruzzi Bank collapsed in 1343, followed by the Bardi in 1346. Credit vanished across Europe overnight. It took decades for international banking to recover. One sovereign default in a foreign currency brought down the entire medieval financial system. Here's what nobody tells you about financial history. Shadow banking systems, currency, and credit operating outside normal control have existed for centuries, and they always end the same way. Now let's jump to 1950s, London, where the modern version was born. Soviet Russia had a problem. They held dollars from selling oil and gold, but Stalin was terrified the US would freeze those assets during the Cold War, so they parked their dollars in British banks instead. These became Eurodollars, American currency held outside America, beyond the Fed's reach. The mechanics are actually simple, but powerful. Say a Russian oil company deposits $1 million in a London bank. That bank can lend $900,000 of it to a Brazilian company. That Brazilian company deposits it in another offshore bank, which lends $800,000 to a Turkish firm. The same original $1 million gets multiplied through the system. It's money creation, but invisible. By 1964, there were $9 billion in Eurodollars. By 1984, over $1 trillion. Today, we're talking about $14 trillion in offshore dollar-denominated debt, nearly equal to the entire U.S. banking system, except completely unregulated. The explosion happened because U.S. regulations actually pushed dollars offshore. Regulation Q capped interest rates American banks could pay on deposits. Reserve requirements locked up bank capital. So the smartest money fled to London, Singapore, the Cayman Islands, anywhere the rules didn't apply. Citibank and Chase built empires in the 1970s through the syndicated loan market, pooling Eurodollars to make massive loans to foreign governments and corporations. They were lending dollars they didn't technically have, backed by nothing but the belief that dollars would always be available. The key players emerged. London remained the hub, but Hong Kong exploded for Asian dollar lending, Luxembourg for European corporate debt, and the Cayman Islands for the really shadowy stuff. Hedge funds and special-purpose vehicles that even other shadow banks didn't want to touch. This parallel dollar economy grew bigger than most countries' entire financial systems. European banks, Asian corporations, emerging market governments, all hooked on cheap dollar loans that existed outside anyone's control. It was Amsterdam in the 1760s all over again, when Dutch banks created complex credit instruments backed by colonial trade expectations, building leverage on top of leverage until the whole thing imploded during the 1763 crisis. August 9th, 2007. That's the real date the financial crisis began. BNP Paribas, one of France's biggest banks, froze withdrawals from 3 investment funds. Their reason? They couldn't value the assets, because the complete evaporation of liquidity in certain market segments of the U.S. securitization market has made it impossible to value certain assets fairly. Translation: the Eurodollar market had frozen. European banks had gorged themselves on dollar debt, using it to fund everything from Spanish real estate booms to Irish construction bubbles to their own trading operations. They borrowed short-term dollars and lent them long-term, the classic banking game, except they were doing it offshore where nobody was watching. Here's the nightmare scenario. These banks needed to roll over billions in dollar loans every single day. But they're not American banks. They can't just walk up to the Fed's discount window and borrow dollars in an emergency. When money market funds and American banks stopped lending to them in August 2007, they faced a bank run, but in dollars, not their own currencies. This was the 1920s Weimar Germany crisis playing out in real time. Germany had borrowed heavily in dollars and British pounds after World War I to pay reparations. When American banks stopped lending in 1928 to 1929, Germany couldn't roll over its debts. Banks failed, the currency collapsed, and the country spiraled into the chaos that led to, well, we know that story. In 2008, European banks were playing the role of Weimar Germany, drowning in debts denominated in a currency they couldn't print. The LIBOR market, the London interbank offered rate, the benchmark for trillions in loans worldwide, simply stopped working. Banks wouldn't lend to each other at any price because nobody knew who was actually solvent. The rate that was supposed to reflect normal lending costs became meaningless. Let me give you the scale of the disaster. Deutsche Bank, Germany's flagship financial institution, came within days of collapse. They had over $1 trillion in dollar-denominated derivatives and loans but couldn't access dollars. Northern Rock in Britain suffered the first bank run in the UK since 1866. Iceland, an entire country, went bankrupt. 3 Icelandic banks had borrowed over $100 billion in Eurodollars, nearly 10 times Iceland's entire GDP, and used it to speculate on everything from British retail chains to American subprime mortgages. When the Eurodollar market froze, Iceland's banking system imploded in 1 week in October 2008. ATMs stopped working. The currency fell 50%. The country nearly had to abandon its own money entirely. The Fed had to save foreign banks to save America. In September 2008, Ben Bernanke and Treasury Secretary Hank Paulson opened emergency dollar swap lines with foreign central banks. They were basically printing dollars and shipping them to the European Central Bank, the Bank of England, the Swiss National Bank, who then gave them to their failing banks. At the peak in December 2008, the Fed had lent out $580 billion to foreign central banks. Most Americans have no idea their central bank was bailing out Deutsche Bank, UBS, Credit Suisse, and dozens of other foreign institutions. The Fed became the lender of last resort for the entire planet. The real economy impact was devastating. Global trade collapsed 20% in 6 months, the fastest drop since the Great Depression. Why? Because trade finance runs on Eurodollars. When a Chinese factory ships goods to a European retailer, a bank issues a letter of credit in dollars. When the Eurodollar system froze, those letters of credit were worthless. This was the 1980s Latin American debt crisis on steroids. Back then, Mexico, Brazil, and Argentina had borrowed heavily in dollars during the 1970s when rates were low. When Fed Chairman Paul Volcker raised interest rates to 20% to fight inflation, those countries couldn't service their debts. Mexico defaulted in August 1982, triggering a cascade across Latin America. The lost decade that followed saw economies contract, currencies collapse, and entire generations impoverished. Now here's where this matters today, because we rebuilt the exact same system, just bigger and more fragile. After the 2008 crisis, that $14 trillion offshore dollar debt dropped to around $9 trillion as everyone deleveraged. Banks were terrified. Regulators promised reform. We'd learned our lesson, right? Wrong. Since 2015, it's grown back to $14 trillion. The shadow empire rebuilt itself. Here's what happened. After 2008, the Fed dropped interest rates to zero and kept them there for 7 years. Then near zero for another 7. Cheap dollars flooded the world. Emerging market companies and governments gorged themselves on dollar loans. Chinese property developers, Turkish conglomerates, Brazilian state companies, all borrowed in dollars because the interest rates were irresistible. China alone has $2.8 trillion in offshore dollar debt. Not government debt, corporate debt. Real estate developers like Evergrande and Country Garden borrowed hundreds of billions to build ghost cities. They took dollar loans because dollars were cheaper than yuan, betting the yuan would stay stable against the dollar. That bet is falling apart. But here's the trap, and this is where the historical pattern kicks in. The Fed just raised rates faster than any time since Paul Volcker in the 1980s, from 0% to 5.5% in 18 months. Every rate hike makes those dollar debts more expensive to service. And most of this debt isn't permanent. It has to be rolled over every few years. When it comes due, borrowers need to take out new loans at much, much higher rates. It's the 1980s debt crisis playbook, step by step. The Fed fights inflation by raising rates. Emerging markets that borrowed in dollars get crushed. The dollar itself has strengthened over 20% against most currencies since 2021. For a Turkish company that borrowed dollars, that means their debt just increased 20% in their own currency, even if the interest rate stayed the same. For an Indonesian manufacturer, every dollar they owe now costs 20% more rupiah to pay back. Countries are burning through their dollar reserves trying to defend their currencies and pay their debts. Sri Lanka ran out in 2022 and collapsed completely. Government default, no fuel, no medicine, president fleeing the country. Pakistan is teetering on the edge, reserves down to a few weeks of imports. Egypt, Tunisia, Ghana, all showing cracks. Japan, the world's third largest economy, had to intervene in currency markets for the first time in 24 years because the yen was collapsing. Why? Japanese investors had borrowed trillions in cheap yen and bought dollar assets, the famous carry trade. Now they're desperately trying to get dollars to unwind those positions, but there aren't enough dollars available. European banks are back in trouble. Deutsche Bank's stock price has fallen 30% in the last year. Credit Suisse had to be rescued by UBS in an emergency government-forced merger. These banks are sitting on hundreds of billions in dollar-denominated loans and derivatives, and they're starting to realize those positions might not be safe. The corporate debt bomb is ticking. Emerging market companies have $500 billion in dollar bonds maturing in the next 2 years. In a zero-rate world, they could refinance easily. At 5.5% rates, many can't afford to. Here's the historical parallel that should terrify everyone. We're watching the British pound's decline in real time, but with the dollar. After World War II, Britain tried to maintain the pound as the global reserve currency. There were massive sterling balances held offshore, pounds in banks around the world, claims on British wealth. When countries tried to convert those pounds to dollars after the war, Britain couldn't pay. They had to devalue in 1949, again in 1967, and eventually gave up. The pound lost its reserve status because Britain had overextended, made too many promises it couldn't keep. So what happens next? History gives us a clear playbook in 3 stages. Stage 1, currency crises in emerging markets. This is happening right now. Countries run out of dollars, can't pay debts, currencies collapse. Sri Lanka is done. Pakistan is next. Then comes a wave through Africa and Southeast Asia. Capital flees these markets, making the dollar shortage worse. It's a vicious cycle. The more people need dollars, the scarcer and more expensive dollars become. Stage 2, European bank stress. This starts in 2025 as maturing dollar debts can't be rolled over. Remember, European banks hold trillions in dollar assets funded by dollar borrowing. When they can't refinance those positions, they face the same crisis as 2008, except this time their governments are already heavily indebted from COVID spending. France, Italy, Spain, they don't have the fiscal space to bail out their banks like they did in 2008. Stage 3, global dollar shortage and trade freeze. This is the endgame. When both emerging markets and developed country banks are desperate for dollars simultaneously, the Eurodollar market locks up completely. Imagine you're a European company importing electronics from China. Normally, your bank issues a letter of credit in dollars, a promise to pay the Chinese manufacturer when the goods arrive. But if banks can't access dollars, they can't issue those letters of credit. The Chinese manufacturer won't ship without payment guarantee. Your warehouse stays empty. Your customers can't get products. Multiply that across every industry, every country, and you get a global depression. Now, here's why this time is worse than 2008. The Fed's hands are tied. In 2008, inflation was low, so the Fed could print unlimited dollars and bail out everyone. Today, we're fighting inflation. If the Fed opens those dollar swap lines again and prints $500 billion to save foreign banks, what happens to inflation? It explodes. The Fed faces an impossible choice: save the global financial system and watch inflation spiral, or fight inflation and watch the world economy collapse. There's no good option. The political problem makes it worse. In 2008, the public was angry about bank bailouts, but most Americans didn't know the Fed was also bailing out foreign banks. Now imagine trying to explain to American voters that we need to print trillions to save Deutsche Bank and China's property developers while Americans are struggling with high prices. You have to go back to the 1930s to find a parallel, when the gold standard locked central banks into impossible positions, and they couldn't print money to stop the banking crisis. We don't have a gold standard today, but we have something similar. The Fed can't print unlimited dollars without destroying the currency's value through inflation. So what does this mean for regular people? How does an obscure Eurodollar crisis affect your daily life? First, imported goods get more expensive. Everything from electronics to clothing to car parts. If it's made overseas and shipped here, it requires dollar trade finance. When that financing gets expensive or unavailable, prices spike. We saw a taste of this during COVID supply chain disruptions. A Eurodollar crisis would be 10 times worse. Gas prices will surge. Oil is priced in dollars globally. When there's a dollar shortage, oil-producing countries can't easily sell their oil, supply disruptions hit, and prices at the pump explode. Remember 2008? Gas hit $4.50 a gallon during the crisis, and that was with collapsing demand. Imagine the same dollar stress with normal demand. Here's the geopolitical angle nobody's talking about. China and Russia are watching this slow-motion train wreck and preparing. They're building alternative systems, the BRICS currency discussions, China's cross-border interbank payment system, CIPS, to rival SWIFT, oil trading in yuan instead of dollars. They learned from the 1980s and 2008 that depending on a currency you can't control is a death trap. The Eurodollar system's collapse might finally give them the push they need to abandon the dollar system entirely. If that happens, the dollar loses its reserve currency status, and America loses the ability to print money the whole world accepts. That's the real long-term threat. But here's the irony. Crypto enthusiasts talk about Bitcoin as the decentralized alternative to the dollar. But the Eurodollar system is the decentralized dollar, $14 trillion that exist outside government control, created by banks through lending, operating in the shadows. It's everything crypto promises, except it's real and it's existed for 70 years. What happened to Rome when its shadow currency system collapsed? The empire fragmented. Provinces started using local currencies. Trade shrank to regional networks. The economic unity that had made Rome powerful shattered. The Eurodollar system's collapse won't end the world, but it will reshape it dramatically. Global trade will shrink. Supply chains will regionalize. The era of cheap goods from anywhere to anywhere will end. We'll go back to a more fragmented global economy like the 1950s, with regional trading blocks and limited financial integration. The Eurodollar time bomb is ticking. The question isn't if it explodes, but when and whether you'll be ready.